Net profit and loss broken down by year of coin acquisition. The class of 2025 and 2026 have collectively puked out $1.5 billion a day in losses on the move lower. That's the equivalent to June 2022, which is FTX days. That's the $17,000 per Bitcoin. Capitulation has begun. We are in the thick of it. We are in the eye of the storm, baby. This is where the money is made. No pain, no gain.
Capitulation, forced selling, billions wiped out in days. This is the phase of the cycle investors talk about in hindsight, but struggle to survive in real time. Confidence is fragile. Sentiment is collapsing. Every price move feels heavier than the last. And in moments like this, the market doesn't just test portfolios. It tests psychology, patience, and conviction itself. In his recent podcast, Jack Mallers speaks directly to that environment. His assessment is blunt and deliberately uncomfortable. From his perspective, what we're seeing isn't unusual market noise or random weakness. He describes it as the eye of the storm, the phase where leverage gets punished, fragile positioning collapses, and pressure intensifies before conditions begin to stabilize. What makes his argument particularly interesting is the interpretation beneath it. Falling prices, he suggests, do not automatically mean a broken thesis. They often signal stress inside the system. Liquidity shifts, leverage unwinds, forced behavior. The distinction may sound subtle, but for investors navigating volatility, it is everything. In the next few minutes, we'll break down Mallers' core thesis, what the data is signaling, why he believes this pain may be closer to ending than many expect, and what it means for investors trying to stay rational in a market driven by emotion. If you value grounded, clear-eyed analysis during periods like this, take a second to like the video, subscribe to the channel, and turn on post notifications for more informative and insightful analysis. Thanks and enjoy the video.
Here's what I need you guys to understand. I think we are not in the beginning innings of pain. I think we're in the latter half of the pain. I'm not saying that was the bottom. I'm not saying we're going to 100K. These things take time. That's okay. Okay, that's okay. We can do it. We're going to be fine. Okay? This is all healthy. It's all good. We had to wash out these tech bros at some point. I'm glad it's now than later. Okay? But I wanted to walk you guys through just visually why I think, according to data, we're closer to the end of this pain than you think. So first of all, the classic cartoon, the stay humble cartoon. Now, stay humble is usually when the price is way high. What's the opposite of stay humble? Stay convicted. But my point is, look yourself in the mirror and remind yourself, why are you in Bitcoin? What gave you conviction in the first place? Because I'll tell you guys this. The price dropping didn't change that there's going to be a block every 10 minutes on average, didn't change the monetary policy, didn't change the monetary properties. Nothing has changed, okay? This is why you have to not use too much leverage, not exceed your means, earn more than you spend, okay? Be responsible, be humble, always be stacking. Here's another thing. If you wanted to sell, now obviously hindsight's 2020, should have done it. Don't do it now is my point. At least, obviously do what you need to do, but I would advise against it. Okay, so now let's look at some charts and reinforce what I think. I think this is very healthy. I think this is a good thing. Better now than later. We had to go through this at some point. Let's go. The only way out is through, baby. So the first chart, nothing more than a healthy correction. So if you just zoom out a little bit, the chart looks great. We made new all-time highs that we had previously set during the COVID era. We went up to 125,000. We're coming back down, finding some support and accumulation back around those all-time high levels between this $60,000 and $70,000 number. And I think we're going to be primed to make more all-time highs. The chart looks really healthy. Some more just chart, some data for your eyes. This is the longest oversold since weekly RSI peak in Bitcoin's history, okay? So Bitcoin has now been oversold for 100 bars. So what I'll show you guys from here on out is why I think this is not the beginning of a bear market. As I've said before, I think Bitcoin's not been in a bull market for quite some time because I look at it measured in gold, not in dollars. Dollars distort your reality because they're printed out of thin air. So it really messes with how you view the world. How much is an egg really worth? How much is a house really worth? It's really hard when everything's measured in dollars. It's like wearing junk goggles. Okay, so I don't think Bitcoin has been in a bull market recently. It's been trending down against gold. If anything, I think we're in the back half innings of a bear market. I think the pain will subside soon. How do I know that? Well, let's look at this one. BTC percent of the supply in profit. Only 50% of active Bitcoins are in profit. That is insane. Bitcoin's at 70,000 and only half of Bitcoins owned are in profit. And by the way, if you look at this chart, in 2015, Bitcoin found a bottom when a little under 40% was in profit. Then a little above 40%. It found a bottom in 2019. And then in 2023, a little under 50%. Now it's a little over 50%. And you have to ask yourself, okay, does that logically make sense? I actually think it's fascinating. Yes, every time Bitcoin finds a bottom, it should be a little bit higher in percent supply and profit than the last time. Why? Because what is happening? Tourists are getting shaken out. People here for high time preference and for the wrong reasons are getting shaken out. Eventually, over time, you build a really, really strong base of people that are monetizing Bitcoin and saving in it with no intention to ever sell, to capitalize their family, to capitalize their business, to capitalize their life, right? And so every single time Bitcoin finds a bottom is slightly less percent supply in profit than last time because the capital base under it has gotten stronger. Okay, so the first bottom Bitcoin found in 2015 was a little under 40%. The next bottom in 2019 is 40%. The next bottom in 2023 is a little under 50%. Now we're approaching 50%. So if you're to say, is this the beginning of the bear market? Are we in for a lot more pain? Listen, I don't know what the bottom is going to be. Could we get another wick down into the 50Ks, into the 40Ks? Sure, I have no idea. Okay, I have no idea how much leverage is in the system. I have no idea who's about to blow up. Who knows? But are we at the tail end of the bear market? Yes. According to data, yes. Hang in there. Hang in there. Hey, you're okay. You're going to be okay, guys. I mean, the sentiment online is insane. We're going to be okay. Okay, the capitulation has already begun. I am a subscriber to Checkmate Stuff. Highly recommend it. This tweet from him. Net profit and loss broken down by year of coin acquisition. The class of 2025 and 2026 have collectively puked out $1.5 billion a day in losses on the move lower. That's the equivalent to June 2022, which is FTX days. That's the $17,000 per Bitcoin. Capitulation has begun. We are in the thick of it. We are in the eye of the storm, baby. This is where the money is made. No pain, no gain. You better stiffen up that upper lip, mother. Okay? You're going to survive. You're going to be okay. You want to come to this show and get a little bit of optimism and get a pep talk? Man up. Man up. You're okay. Okay? We're not in for another 2 years of pain. We're almost to the other side of it. Brace up. We're washing out the tech bros. Liquidity is rotating. Bitcoin's the scarcest thing you can get your hands on. This thing's going to reprice higher. Clench those cheeks. You're going to be okay. Okay. The Mayer multiple. The Mayer multiple just takes Bitcoin's price over the 200-day. Okay. So it's just trying to find how is Bitcoin's price performing against the trend. Okay, the Mayer multiple is approaching deep value, okay? Look at the bottom there. As low as these things have gotten when they found bottoms, we are approaching deep, deep, deep value. Meaning, can Bitcoin go lower? Sure. Can Bitcoin have already bottomed? Yes. Yes. This is the time to turn on your DCAs. This is the time to convert your paycheck into Bitcoin. This is the time to get some exposure. This is not the time to lose conviction.
Mahler's central claim is deliberately balanced. This is painful, but it is not unprecedented. He isn't calling an exact bottom. He isn't promising immediate new highs. Instead, he reframes the discussion around probability, positioning, and market structure. Corrections, he argues, are not anomalies in Bitcoin. They are features of the asset's history. Volatility is not evidence of failure. It is the mechanism through which excess gets removed. More importantly, Mallers challenges the psychological trap that dominates bear markets, confusing price action with thesis deterioration. Bitcoin's issuance schedule has not changed. Blocks continue to arrive roughly every 10 minutes. Monetary policy remains fixed, yet investor behavior swings dramatically because market participants are reacting to valuation shifts, leverage pressures, and broader liquidity dynamics, not fundamental breakdown.
Look at the moving average in the Bitcoin price. We have entered a zone where it is historically really valuable to buy. Sometimes it's that simple. You've only had, in the last decade or so, you've only had 3 other opportunities to acquire at this relative price. And look at, sometimes Bitcoin hangs around here, under here for a while, and sometimes it sharply recovers. Okay? The 2021 is what I want you guys to look at. That was COVID. Bitcoin dropped 50% in a day. Everyone's panicking. Everyone's selling. Bitcoin's going to zero, blah, 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 blah. And then it went from $3,000 per Bitcoin to $70,000 per Bitcoin in like a year. So turn the DCA on. Here's the thing. Here's what you guys need to decide for all the people that are emotionally damaged. And by the way, I'm not saying that this is easy. When the next time people say, oh, you just got lucky. This reminds me of like when all the people from my hometown or all the people that aren't in the industry say, oh yeah, you just got lucky. I just got lucky. Do you have any idea how hard it is to hold something from $50 per coin to $125,000 per coin and not touch it? Do you know how hard it is to have an asset go down 80% plus over and over and over again? And for the smartest, most credible people in the world, for the world's politicians, for everyone that you're supposed to trust, you're supposed to learn from, you're supposed to care about, everyone's saying you're an idiot, you're wrong, you're stupid, you're poor, and not listen to them. Do you know how hard that is? So the next time, in a year from now, when Bitcoin's at 200K and someone says, oh, you just got lucky, you. These are the times you earn it, okay? These are the times you earn it. Double down on that conviction. No fee, no spread, DCA, paycheck conversions on strike. Start getting yourself some corn. Hang in there, okay? And the last chapter I have for you guys is that all the clues are right in front of us. So is this going to be a multi-year bear market? Again, according to the data, everything that I check on when we get into bear markets, guys, I've been in this game for a long time. I've been in this game for well over a decade, okay? I check the same KPIs. I check the same things to get a pulse on the market, to see how we're doing, okay? According to what I look at, we're in the bottom 20%, 10%, maybe 5% of the back half of the bear market. There's not that much pain left. Now, how fast are we going to go up? When's the new all-time high? I don't know. Of course, I can't know that. Anyone that tells you they know that is a liar. They're selling you something, okay? But what I can tell you is the clues in front of us are apparent. You just have to open your eyes. So this chapter is called All the Clues Are Right in Front of Us. Okay, Bloomberg, this is very sneaky. This didn't catch a lot of Bitcoiners' eyeballs for some weird reason. I couldn't believe it. You've got Anthropic and AI and the Super Bowl and Bad Bunny and the halftime show. Woo! All the shit. Okay, Bloomberg came out with an article. Warsh call for Fed Treasury Accord stirs debate in $30 trillion bond market. Okay, I'm going to skip to the bottom of this article and read, looming over any Fed Treasury talks would be Trump, who last year argued that one of the central bank's duties in setting interest rates is to mine the government's debt costs. Those are currently running at an annual clip of $1 trillion a year, or half the budget deficit. Quote, rather than insulating the Fed, it could look more like a framework for yield curve control. Tim Doy, chief U.S. economist of SGH Macro Advisors, said of an accord, a public agreement that synchronizes the Fed's balance sheet with the Treasury financing explicitly ties monetary operations to deficits. Guys, the clues are right in front of you. You just have to be paying attention. Bloomberg and Warsh and The chief U.S. economist of macro advisors is telling you they're planning yield curve control, which, by the way, let me put that in layman's terms. That means the Fed is going to print dollars out of thin air to buy U.S. treasuries, which is another way of saying the Fed is going to print dollars out of thin air to lend to the U.S. government, which is another way of saying the United States is going to print money out of thin air. Highly inflationary, highly good for things like gold and Bitcoin. Like, the clues are right in front of us. Remember, Warsh is a politician. Do not believe for a second he's anything other than that. Trump jokes about suing Warsh if he doesn't lower rates. So what have we read since this guy got nominated? Trump is going to sue him to oblivion if he doesn't listen, and that he is a Besant disciple, a Stanley Druckenmiller disciple, and they're planning some type of relationship with Treasury to cap rates on treasuries and implement some form of yield curve control. The clues are right in front of you, okay? Right in front of us. Hang in there. Hang in there. Get these tech software levered Wall Street junkies out of our asset class. Buy their dip. If Bitcoin is capitalized and held by hodlers of last resort, of people that are monetizing it, that are saving in it, it will start trading like a hard asset. It's never made sense that it traded like a tech stock. It's because a lot of these tech guys got into it over the 2010s in these large swaths of liquidity. And now that there's a liquidity regime change, a lot of that's unwinding. Hang in there. Turn on your DCAs. We are almost home. We are almost home.
Jack Mallers' framework rests on a simple but powerful observation. Markets are cyclical, leverage is reflexive, and stress events often cluster near inflection points rather than beginnings. Capitulation, by definition, is a late-cycle phenomenon. It represents exhaustion, not enthusiasm. When Mallers points to metrics like percent supply and profit, oversold conditions, and deep value indicators, the argument is not that downside risk disappears. It is that risk and opportunity begin to overlap. Historically, Bitcoin's most uncomfortable periods have also been its most asymmetric entry zones, not because pain guarantees recovery, but because valuation compression resets expectations, positioning, and forward return potential. Equally critical is his macro lens. Bitcoin does not exist in isolation. In recent years, correlation with tech equities has increased, driven by shared investor bases, liquidity flows, and institutional portfolio construction. When capital rotates aggressively into themes like artificial intelligence and large-scale capex spending, risk assets, particularly those viewed as high volatility, often absorb disproportionate pressure. Mallers interprets this not as a rejection of Bitcoin, but as a liquidity regime story. Funds reallocate. Leverage unwinds. Crowded trades deflate. The market, in effect, reprices risk across the board. In that environment, Bitcoin temporarily behaves less like an independent monetary asset and more like a liquidity-sensitive instrument. But this is precisely where his longer-term thesis reemerges. If Bitcoin increasingly transitions into an asset held by high-conviction, low-time preference participants, what Mallers calls hodlers of last resort, its trading behavior may gradually shift. Less reflexive speculation, less forced liquidation, more alignment with hard asset characteristics rather than tech stock volatility. That transition, however, is rarely smooth. It requires drawdowns. It requires shakeouts. It requires periods where narratives weaken, participation thins, and conviction gets tested. Selling fear. Chasing relief rallies. Confusing volatility with invalidation. Mallers' message, stripped of rhetoric, is fundamentally about discipline. Avoid excessive leverage. Operate within your means. Separate thesis from price. Recognize where we are in the cycle, not just how it feels. Most investors fail not because markets collapse, but because psychology does. If you found this breakdown valuable, make sure to like the video, subscribe to the channel, and share your view in the comments. Are we witnessing late-stage capitulation or the early phases of deeper structural pain? Thanks for watching.